Good morning, everybody. Welcome to the Flow Show. Friday, we got through it for you Yanks on board. A nice short week for you. For the rest of us, a big return from the summer break. Morning, Kay. How you doing, mate?
Hey, morning, Ryan. Morning, everybody. Yeah, doing well, mate. Glad it's Friday.
Yep, looking forward to it.
What a hot Friday it is as well.
Yeah, a bit muggy today, isn't it?
Yeah, it is.
Yeah, I don't like it when it's humid. Don't mind the sun, but not when it's humid.
Yeah.
Just you have to sit in my office sweating away. But that's what we do for the cause, I suppose.
That's what we do.
Right. What can we do? Let's crack into it. The PBOC have fixed $1 above 720 for the first time in ages. They fixed above 721.50, or they fixed at 721.50. They have been keeping it sub 720 for the last few weeks. That was seen as a bit of a green light to take one pairs higher. As you can see, CNY up there above 734, breaking the prior highs we got in August. Dollar China having a look up as well, got above the prior high, run into trouble just ahead of 36.50s, where I've got a bit of a level there, which reminds me I might need to adjust my stops there. I'm short this one very small on the way up here from earlier, when round about here I started shorting it, added in this move here, keeping that on, but I'm not overly keen at the moment. I'm hanging on by the skin of my teeth. But anyway, move above 736. It hasn't held. I saw you posting the room, mate. Was that confirmed that banks were in again selling?
No, not at all. I mean, it was kind of an expectation that we would see the headline come up that they were in. But you know, I mean, I've been talking about this dollar CNY band now for well, if not weeks, days at least. And it does seem every time the dollar CNH reaches the top of the dollar CNY band, there's something going on there. So I wouldn't be surprised if they were sniffing around at that level. And the top today is around 736. So we just overshot it just that little bit. And then it came straight back off. And I suspect that is not a coincidence.
Yeah, very much. So definitely looks a stepping in, shall we say, by banks when you get moves like that. That's certainly what it looks like. So it's had a little knock on the head. We'll have to see whether it's just a slowing move or whether they're going to try and draw a bit of a firmer line up here. But the fact they let the fix go a bit suggests that they're open to letting it roam, shall we say.
Yeah, I think next week fixings will be pretty important, right? To see if they keep going in the direction of the market, or if they stop it again. Seeing that the market immediately reacted to the fixing above 720 may tempt them to use their buffer again and put it back, counter-cyclical buffer and put it back sub 720. I don't know. I mean, that remains to be seen next week, but it's interesting at least that they are above 720 right now.
Yeah, I wonder if maybe we're heading towards an RRR cut, further moves by the PBOC. You know, just to really give it a bit of a stamp.
Yeah, but they did cut the FX requirements already, so
yeah,
I'm not sure whether they can cut them a lot further. Because doing the normal RRR would actually be negative for the Yuan, right?
Yeah,
that's nearly like a rate cut. So
yeah,
I don't think they, unless they said, okay, we held it back long enough now, let the market do its thing a bit. That could, because they are still in the mode of trying to revive the economy, right? So it could be, but that would be a surprise move and put a lot of pressure, I think, on CNH.
Yeah. And I'm just looking at Chinese stock markets there, which you need to keep half an eye on, because that's a bit of an indicator as well as to when they might step in and still not. They've got programs going on there where they've asked for buybacks, asked for, you know, net firms to stop net selling and that sort of thing. So the pressure's on, and they're not seeing any moves for the orders they've been given out so far. So yeah, sometimes they're trying to use a hammer to nail things down. Maybe it needs a sledgehammer to do it. But anyway, we'll keep an eye on things like that. Moving across to Japan, and a bit of data out overnight. GDP data and a few other bits and bobs as well. GDP with final numbers coming in there, a little softer than expected. Q2 1.2% versus 1.5 expected. On the year-on-year, 4.8 versus 6% expected. CapEx down 1%, which isn't a good reading for that there. So the numbers there not looking overly good either. Consumption a bit softer there as well. And later on we got the economy watchers index, not a huge number, but just one of those ones we'll look at because it makes up all part of the picture. A little bit softer there, 53.6 as well. Now dollar China had a little bit of a knock this morning or overnight as well. We did have Suzuki coming out on the bandwagon, saying FX market should reflect fundamentals. Excessive FX moves aren't desirable. We'll watch moves with a high sense of urgency. Won't rule out any options. Blah 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 blah. The usual stuff. Not mentioning the speculation line like Canada did. So it seems that Canada's on DEFCON 1 and the rest are on DEFCON 2. A little bit of disparity there, perhaps. What do you make of that?
Yeah, so running through everything, it's a mixed bag on the data. That's one thing, because one could argue that the pretty positive current account that came out, that's relatively positive, right? Better bank lending numbers as well. But then a number which is never taken up in those numbers, unless I missed something, is the real wages, and they are negative again. So real wages are negative. Okay, perhaps you can just subtract inflation from the overall wages, and then you come to the same conclusion. But they are negative again, and that's something that the Bank of Japan doesn't like to see, right? And then you have Suzuki. And then we have this dollar yen move, which is a bit strange, because if I go strictly at the timeline for when the dollar yen dropped and then bounced back, and Suzuki, it seems that the Suzuki headline came after we had that drop in the dollar yen. So is it have we seen some sort of checking rates? But then I suspect the wires would have picked up on that. Or is it just like Tokyo opens, let's go for the stops, get them out of the way, and then take up normal activity again? Or is it that in Japan they already had those Suzuki lines, whether he was talking in parliament or so? That's a possibility as well. But it's a bit strange, this move in the dollar yen, that it happened before the official, let's say, lines or the main wires picking up the Suzuki lines. So yeah, there's a couple of things happening there. But then at the end of the day, when the dust settles, we're still above 147. Yeah, not a lot changes, right?
I think that's the key point. Whatever happened there, we got quickly back above 147, and straight after held it again. So could have been a big order catching the market on the on a quiet moment. Who knows what it was? But the fact that it washed out pretty quickly, and we're back holding, suggests that we might probably ignore that move for now.
Must have been like or stop running just as Tokyo opens,
just catch a few people off, and the real level is still 147. So we'll be keeping an eye on that anyway. Right, moving on. Poland, you'll recall, cut rates by a huge chunk yesterday, 75 basis points where 25 was expected. We've had a couple of Poland's MPC members out talking about it. Tarowicz says that nothing indicates CPI is under control. He's a big hawk over at the Polish Central Bank, who has been saying for ages that they haven't done enough on rates to control inflation. So he's not too happy with a cut over there. Another one, Kateki, says that 75 pip rate cut is interpreted as being part of the election campaign. That sounds more likely. Poland heading towards elections, and rates at 6.75% are not going to be going down well with the population. So you want to get points on the election, you bring rates down and make things a little bit more easier. But it's not huge in the global context. It looks like there's shenanigans at play there for that rate cut. So despite me clickbaiting that this was the start of the big hike cut cycle, there's other things at play going on in Poland. Over in Germany, we've had more growth cuts. The DIW Institute has cut its 2023 GDP forecast to minus 0.4% from minus 0.2%. That matches what we heard from the IFO yesterday as well, who also forecast minus 0.4% for 2023. They also cut their 2024 forecast a pip to 1.4%. So all the big German institutes not seeing any good news for Germany. But even at 0.4%, it's, you know, that's not talking an outright collapse. You can see the data brand, but that's not data. That's just headlines. So it's not on any calendars anywhere. What you can see is US jobless claims from yesterday, which came in at a healthy 216,000. So still no problems being flagged there. The 4-week average coming down a good chunk as well. Continued claims down as well on that. We also got some Q2 unit labour costs. One of these numbers that in his little appearances at various FOMCs, Powell's drop different data points that they look at. This was one of them, unit labour costs coming in more than they were in the flash number. 1.6%, I believe, was the prior flash number. These were revised numbers, so that was a little bit hotter at 2.2 and a little bit softer than expected on productivity, depending on what calendars you look at 3.5% there. Canada's Ivy PMI with a gangbusters numbers there. The main PMI, this is the season adjusted one that most people look at, was expected to improve to 49.2, but it blew that out the water, going back into expansion at 53.5. The non-seasonally adjusted number as well, going up over 11 points. That's a huge number for these PMI data. So apparently everything's tickety-boo suddenly in Canada as far as the PMI there.
Yeah,
yes, mate.
This Ivy PMI and nobody even watches.
Oh yeah, it's flaky as
yeah, I mean it's pretty it's pretty unpredictable, and we have seen it yesterday again, right? Nobody even reacted to it. The dollar cap didn't even move on it when it came out, you know.
Yeah, it's a bit of a funny one. This one's a bit like the Michigan number. If the market's doing nothing else and wants to trade something, it will trade it. Otherwise, it mostly ignores it, because when we had those big drops, when it pretty much collapsed, I remember the CAD moving on it then. But as you can see, it hasn't lasted long. We're back up, so maybe a little bit of a one-off. That was the collapse there. But yeah, anyway, that goes into the pot when looking at Canadian stuff. Anyway, we had Macklem out, our mate Stiffers out, speaking to, I think it was like a Chamber of Commerce type thing, run at the Bank of Alberta, saying that the Bank of Canada is worried about the persistence of core inflation. Did say policy may be tight enough to restore price stability. Maybe we don't need to do more, but maybe we do, when speaking on rates. Now, dug into I read the actual speech itself, and in my opinion, it matched what we saw from the statement at the BOC, that there is perhaps a more hawkish slant to this than there was before. He said you can expect headline inflation is going to go up in the near term before it eases. We are not there yet, and we are concerned progress has slowed. Monetary policy still has a lot of work to do to restore price stability, and we are committed to staying the course. It then said, with past interest rate increases still working their way through the economy, monetary policy may be sufficiently restrictive to restore price stability. However, the Governing Council is concerned about the persistence of underlying inflation. Inflation is still too high and there's little downward momentum in underlying inflation. We know high interest rates are hitting some Canadians hard, and we don't want this to be harder than necessary, but letting too high inflation persist would be worse. So in my opinion, and everyone can feel free to disagree, I'm seeing a little bit more hawkishness from them at the moment. I think if we get another hot CPI, probably 2 would seal the deal. 2 higher reads in CPIs, I reckon they hike again, personally. And the early pricing for their next meeting, which is in, I'll refresh myself, 25th of October, is 86% chance of staying unchanged at that meeting. But another CPI number, and I think that'll change. Same for the Fed next week. We're pricing a 93% chance of them staying unchanged, but we do have CPI next week. And if that's another hot one, we're going to see those expectations flipping right around, I should imagine. What did you make it? Did you take anything from Stiffers there?
Oh, man, I mean, it's not the first time they do it. On statement one direction, and then Steve comes out and he tries to soften the stuff a bit. Yeah, but on balance, yeah, they're leaving the door open. Now, the rest is wild speculation, right? If CPI is higher, they probably have another 25 in there. If CPI continues to come down, then they're all going to look at where the risks really are to the economy. I'm talking about risk. I think we have to mention straight away that we have Canadian employment data this afternoon, right?
Yeah,
that could be the clincher for that 137 perhaps on the dollar CAD if it comes in negatively. Last how should I say, last report was really flat. Well, slightly negative, but I mean that doesn't yeah, I mean, as we've been talking about this labor market a bit everywhere, having like this last big domino, whether is it going to fall or not? It may be a bit of a directional one, this one. So yeah, I think McClem was like his self, you know, trying to do a Powell and walk every side of the line and cover every subject.
Yeah.
It's such a fine line. I'm really tempted to say they're all done, all of them. I'm really tempted to say that now. They're all done. But what do you trade? I mean, where's the differential then going to be? Of course, there can be a surprise. The ECB, for instance, is constantly being repriced as well. What do we have to expect from them? But for the rest, I think most of them are kind of done, you know, with the hikes. Yeah, that's my feeling.
Even one, maybe 2 more hikes from some of them, that would be considered done anyway. You know, the end. We know we're potentially at the end of this hike cycle, but then I think the sticky position they're in is that they're reliant on the data. You know, when they were on their hike cycle, you know, the data mattered, but not so much. You know, they were on the high, they knew they needed to get rates up. They'd had rates for 0 for too long. They knew they needed to get rates up. The fact they had to take them up higher was the surprise because they were slow to react. So there was no question about, you know, hiking rates. Now they don't know where they're at. You know, this is like the pendulum swung one way and now it's swinging back, and I don't know how far it's going to swing the other way before it comes back to the center.
And that's what I've been saying now for a couple of weeks. I think the other data now matter more again than just the CPI. If the CPI remains sticky, we know that, and actually the expectations are for it to be sticky in the months just ahead of us. But the real differential is going to be made on the, let's say, the real thing, like employment, wages, housing, whatever.
Yeah.
And where it's going to drive prices to, it's a bit of a question mark. But they are going to tell us whether the economies are holding up or not. And so for the time being, the US is still the least dirty shirt, and that's keeping the dollar beat in a way. But I mean, the real differential will come really where we are going, and it's what we said, right? We are as data dependent as they are now, and
Yeah.
it puts us back to their level. We were front running them massively for a while,
Yeah.
on the hikes and on the stuff. And remember the dollar yen, and well, take away those interventions, but the dollar yen was running up because the Bank of Japan and was diverging more and more and more from other central banks. But now we are really data dependent, and the dollar could actually getting a little more volatile, but not change direction materially. And
Mhm.
same for, I think the euro is slightly different, because I think the situation in Europe is worse than in the US right now. But yeah, the rest is really going to tell us, well, into where.
Yeah, I don't think Europe saw the level of growth that the US did. So it
No,
was a lower bar to get
yeah,
back below than the Fed. But Macklem raised a couple of points that are key in his speech. The first one was on inflation. He said the reason why inflation has come down is because energy has washed out. High energy prices, oil and such, has washed out because prices came down, but now they're rising again. But he also acknowledged that food prices, staples, domestic inflationary pricing had remained elevated. And that's the ones that they need to fight against. That's the one monetary policy affects, not oil prices. And it's the same for everyone else. The UK is in very much the same boat. The ECB, very much in the same boat. So I think they're all scared. They're all scared that inflation might be staying sticky, and that's what's going to keep them on the hawkish side and maybe looking at further hikes. And the second point is talking about jobs. He threw in a chart to show that I don't know how you want to call it, the population growth need of employment was below trend. So like the US, what is it, 100,000, 110,000 is needed per month minimum to keep jobs ticking along compared to population. Well, in Canada, he said that was below trend, the current levels of employment. So they are seeing a bit more weakness there than somewhere else, even though jobs aren't sort of collapsing and unemployment isn't jumping up too high. But anyway, that's what we look at when we go through all this stuff. We want to see where central banks are at, see where the next decision is going to be. At the moment, I think the market is generally underpricing future hikes, be they 1 or 2 or whatever. Particularly for September, I think there's a higher chance the Fed and the ECB hike in September more than the market expect, and that's where we may get our trading opportunities while we talk about it like this. Anyway, let's move on. We don't be doing all these headlines forever. Over to the Fed. Fed Williams needs more data before deciding on the September move. Inflation is far too high but moving down. Says the Fed has done a lot already on monetary policy. Policy is in a very good place and is affecting the economy. The question before the Fed is, does monetary policy need to become restrictive? It's an open question if policy is restrictive enough. So that would sense he's still got a wider open door for further hikes. It says there's reason to expect some weakening in consumer spending. Fed's Bostic also banging the inflation drum, saying there's still work to do to bring inflation to the 2% target. And this is Mr. Pause himself. He's one of the biggest pausers over there. Fed's Goolsbee nearing a point where it is not a matter of raising rates, but how long to keep them high. Fed's Logan could be appropriate to skip an interest rate increase in September. So sounds a bit neutral on there. But the rest of the comments, work left to do to get to a sufficiently restrictive policy. Skipping does not imply stopping hikes. Not yet convinced we've extinguished excess inflation. Need to calibrate policy carefully and must proceed gradually. Significantly lower inflation in recent months is encouraging, but too soon to confidently say we're on the path to 2% in a timely way. Jobs market strength suggests we have not finished the job of restoring price stability. If stronger economic activity continues, it could lead to a resurgence of inflation. Now, meanwhile, the cutters are getting ready for next year. Wells Fargo thinks the Fed will cut rates by 225 basis points next year. The number is probably about right. When they get there is another question. That's going to be the next part of the central bank trade. Where is the neutral level? Rule of thumb thinking is round about 2.5 to 3%. So 225 pips by Wells Fargo will put the Fed round about that 3% mark. All the banks, or a lot of the banks, are doing their usual flip-flopping on their forecasts, as usual, not worth the paper they're written on. HSBC now sees dollar strength where before it saw dollar weakness into 2024. So they're all jumping on the bandwagon. Probably means we're going to be near a top there soon in the dollar. Walmart, you may remember I brought this up that they were cutting pay for pharmacists. Well, now they're going to cut starting pay for some new hires in various stores. They want to put new hires on the lowest wage level for that store where the person's looking to join. So that's another big company feeling the pinch from wage pressures. General Motors has offered its employees under the what's the union? The United Auto Workers Union, a 10% wage hike over 4 years. That'll give top rate workers a total of a 16% raise. That's still well below the UAW union's demand of at least a 40% wage hike. So still some strike troubles over there. And Australia LNG mob went on strike today as well. It was delayed while they had last minute discussions, but that bore no fruit. So now they have all gone on strike. That's it. Kay, got anything, mate?
Well, one more thing on the sides. The Mexican opposition party leader, and we have elections in, it's not before June 2024, okay? But she called she said that the super peso is harmful for the economy and has been propped up artificially by the central bank's record high interest rate. Now she's calling for cuts in interest rates and for letting the Mexican peso decline, okay? I don't know where she is exactly in the polls, but this is adding a little bit to what Banxico did last week or the week before with that currency hedge thing, which is still rolling on. The market chose to ignore it today, or perhaps it reacted to it yesterday. That's possible. It came out last night, but yeah. So there's a bit of political jockeying and using the currency as well. By doing so, and yeah, I think that's something interesting that we'll have to pen that one down for the calendars, seeing where the ruling party of President Labrador is compared to where she is standing, and she's called Galvez. Okay, so here we go. Let's see where those polls are going to be in the upcoming months, because it could be a bit of a market mover. But for the rest, you covered everything. And yeah, it's a bit worrisome, right, that all those banks are changing their views higher for longer the dollar, especially when being long dollars. That's a bit of a worry. Yeah, so that's it. So now we have to pay careful, not pay attention to when they are going to throw in the towel as well on that. So let's see. I think. Are you muted, Ryan? Or
yeah, sorry, mate. Yeah, I was going to say okay. That strikes a chord, that Mexican news, because you add that to the Polish stuff where the rate cut was maybe politically driven.
Yeah.
We've got the US, the UK, plenty others heading into elections next year. Maybe rates are going to become a bit of a political football to be kicked around. There'll be another angle we might have to look at all these things with, which obviously shouldn't be any sort of effect because central banks are supposedly independent, but you never know what pressure may come from the powers that be in a campaign year. But anyway, let's worry about that next year. Right, let's have a look at prices. Well, as you can see there, Kay will probably delve into this one in a bit more detail, but we're holding that 1740 still. Bounces might be looking a little bit weaker at the moment, so maybe a little bit of a pause there. But while we hold this level, it keeps the break alive. If we get back below there, probably going to spell a bit of trouble for this move that we've seen now. But for now, the trend and the break looks good. Roboto asks, any thoughts on the Kiwi today? Strength out of nowhere. I think this is just part of a bit of a bounce, or in these pairs, a bit of weakness in the dollar. It's still all very small stuff. I mean, look, we're just nudging above 59. It's not like we're rocketing up towards 60 again. It looks a general case of failing to go down further. We're just seeing a bit of a relief rally in these pairs, but as I say, it's still all small moves. You know, we're not doing anything massive here at the moment. So going up 20, 30 pips, I wouldn't exactly call that rocketing. If we continue, if we hold 59, get up through the mid 59s, then maybe we're seeing something different. But until we get above 60 and hold it, I see no reason to change the trend for this one. And you know, the same could be said for the Aussie. Again, if you ain't going to go down, the only other way you can go is up. But we can't get and hold above 64. You know, you can't take these small steps. You're not going to take a big step. And that's pretty much the basis for looking at this at the moment. So keeps the pressure on, in my opinion. We may not be done with the downside, but it's put up a stiffer fight at holding than it has done previously. So that's what you want to see. You want to catch the knife, you know, your levels down around the 63.60s, you know, under 63.40, you're wrong. So you don't need to give it much room if you want to try catching a knife down there. Top side, as I said, you can see your levels, 64. That's where you might want to be able to short it if you fancy it on a scout basis. But again, you know, up above 64.20s, 30s, you're probably wrong on that side, and maybe we're taking another smaller step up. Moving over to dollar CAD, maybe we've finally got a break of this damned 36.50 level, because we've had that move up towards got close to 37, pull back, and it's held around the 50s and bounced from there. So touch wood, probably giving it the kiss of death now. Maybe we are heading up to 37s, maybe even more. As mentioned, we have got Canadian jobs later, so that may be one to keep an eye on. But we've come through all the US data this week, the BOC and everything, and we still couldn't take out 137, nor could we break significantly lower. So it's probably going to take a big number out of the jobs report today to get this moving anywhere significant. Let's have a quick look, see what's expected. Employment change expected to rise 15k versus that drop to drop of 6.4k last month. Keep an eye, as usual, on the unemployment rate, expected to tick up a pip, but also keep an eye on that participation rate. Are we going to see the same sort of thing we saw with the NFP, with the participation rate rising, which largely caused the unemployment rate to rise? Again, if we see that trending higher, that might suggest that people are needing to come looking for work because they ain't got enough money. And just to also keep an eye on the usual revolving door between full-time and part-time, just to see where the jobs are won or lost in that one. Roberto is across all NZ pairs. Kay, you seen anything in Kiwi particular this morning?
Yeah. I can. There's a couple of things going on in the crosses, and
Yeah, do you want to grab it now?
Yeah, why not, mate?
Go ahead.
Oh,
where am I? There we go.
Right. Let me pull up this one. Okay, so you see this Euro Kiwi, right? And I think there's something to do with those crosses as well. And we are coming into a relatively important support zone. We're still trying, if you look at the shorter term, we're still trying to form kind of a flag here to then move higher. But I think those Euro commodity or Euro antipodians are a little bit in danger here. And I have to say, first of all, if you look at the Kiwi for moves, you have to know that the Kiwi market is not very deep, okay? If somebody needs to switch to trade around a few hundred Kiwi or 400-500 or so, they are going to move the market a bit, okay? So and we've seen like the past few days, we've tried the downside on the Aussie, we've tried the downside on the Kiwi, and even in the euro dollar, you know, and we were talking about that in our chat room, how it slowed down everything. And I think it's just a positioning, you know, that a lot of these moves, and then you combine it with the look of some of those euro crosses, which are looking more vulnerable than they were. Yes, we are into support. They could hold 180.80 or 180.30. They can hold, and then we are in the flat pattern and go back above. But if you start to look at it in a different way, and the Euro Aussie is actually a more crying example than this one, we could be in for a deeper move, you know, if we come back down. And I think there's a bit of divergence being traded. The Kiwi, if I recall well, are they not at 5 or 5.5% or so, which is quite a bit higher than where the euro is as well, right? So not saying that there's carry, but if you are like comparing the euro and the Kiwi, it's perhaps better to be short in euro than Kiwi. And I think a lot of it is has been down to positioning on this one. The Kiwi dollar, yeah, it's we've had a try below this this trend line, actually traded below for quite a while, and then we're back above, and I think it's just a case of people stepping out of some of their positions. We've also seen the Aussie Kiwi coming back down from the high 108s, getting closer again to this 108 level. I think it's all part of just the global trade that the market is trading around their positions. I wouldn't really go and look much further than that. There's one that is interesting here, I think, on the Euro Aussie. It looks a bit same as the Kiwi, but to me, this Euro Aussie is starting to look a little bit vulnerable, you know. First of all, we went higher than here, and then in the meantime, we've already starting to form a bit of a trend line here as well. Tried to break, failed, and it's starting to look like this one may want to get down a bit more, but we need to respect, of course, the support here. And I think all of that is a bit similar. Yeah, the Aussie dollar is staying below 64. We had a quick run. Yeah, no, that's the Canadian dollar. We had a quick run above 64 before the European Open this morning, but then we tried to get above this trend line here, but failed. Okay. But then you're going to find it back in all the currencies. You find it back in the euro dollar 107.30. You find it back in the cable 125. In a lot of stuff. There's one we need to take a quick look on those yen pairs, because even though I'm still thinking that in the more medium term, dollar yen is still poised to go higher, and that's my personal view. But some of the yen pairs are starting to look a little fragile, and one of them is this sterling yen, and I think it's holding back the dollar yen in a way as well. All those crosses. Look, we've tried it here. Oh, this was the that overnight move in the dollar yen. I really don't know what it was, and perhaps we just let it be for what it was and move on. But we could argue that it's holding the support, but on the other side, we are starting to test it, okay? So I'd be a little careful because it could have an impact on what's happening in the cable and what's happening. The other one here that I'm really keeping a very close eye on is the euro yen around 157. 157 is your first level before the big one, which is also seen on other time frames, sorry. Around 155, but look at 157. Okay, we are about 0.5% away, but if that starts to break, then it could have a bit of an impact as well on the euro dollar as on the dollar yen. So keep a close eye on that one. As long as it holds, it's still oriented to the top, but it's a bit of a risk. And all those euro crosses, like the euro Aussie, the euro Kiwi, I think are the ones that are now, contrary to what we had before, where euro crosses were supporting the euro, is now perhaps weighing on the euro dollar. And overnight and early this morning, we couldn't even make it above 107.30, which is your first level of interest. So we are now like trading around, Ryan would say mooching around here in this, call it 80-30 zone on the euro dollar. But the end of the week is going to be interesting. If we keep below even the first resistance, 107.30, next week could be one where this euro dollar starts picks up the downside again. We'll have to look at it closely. By the way, ECB is next week already, right?
Yeah, 14th.
Oh, okay, right. Okay, so then we're going to have to be a bit careful with what's happening on the euro. But at least today and since yesterday, I find those euro crosses being a bit, how shall I say, on the defensive. Let's put it that way. And Ryan already showed the dollar max, and it's exactly there. It's 1740, right? The support. And in the euro max, it's this one here around between 68 and 64. So this is one that we have to watch. So we had this big move higher. Then we had some correction, tried it again, went down. Yesterday, we tried again to move higher, but we didn't reach those highs again. So, and I think that has to do again, perhaps with those euro crosses, this whole environment of the euro crosses, and you can even add the euro sterling because we had this look above 86, but now we are failing a little bit there as well, and we are back into a bit of a neutral 85.75 zone. But looking at those euro crosses, I'm feeling a little bit of a impact perhaps finally from those weaker data, and I guess that's when bringing us back to Roberto's findings on the Kiwi is that perhaps it's just euro Kiwi as well, you know. So that's it on those euro crosses. I wanted to highlight some of them because they look a tad fragile to me, and that is in turn weighing on the dollar, on the euro dollar as well. Really, I think for the end of the week, you covered the Canadian dollar. We covered the dollar China. Again, have a look at where we end in the dollar China, and then on the fixing next week. That is going to really be the driver. But PBOC really has the key to what's going to happen in the dollar China. If they are okay to let it slip, then it's probably going to slip. The Chinese yuan, if they say like, well, okay, as soon as we loosen the grip a little bit, you guys are taking dollar China higher, so let's tighten it again. It's all within the possibilities. Just a quick one. We had this run up in the 430s again on the US 10s. Now coming back a little, this 433.36 is going to be your first not your first, but actually a big resistance, because if it would go through there, we could be on our way to 450 and above. So I don't think, with the lack of data that we have today, that we are going to break any fresh ground. But keep an eye on 420, and then for the prior ones, those 408s, 409 again. These are going to be really your drivers, and especially for stuff like Dolly and etc. And with that, Ryan, I'm going to call this a week.
Thank you very much, mate. I'm just going to grab it back quickly before we end the show. We obviously, not a lot of data. Can you see my screen okay, mate?
Yeah.
Obviously got the Canadian data, a bit of wholesale inventory data out, but keep an eye, if you're still about, or have a look over the weekend, the US consumer credit number. This could be an important one. If we are starting to see a bit of weakness creeping into the consumer, it's likely to mean that they start borrowing a bit more, taking more credit to pay the bills. What you want to see, as you can see here, we had numbers much higher than we have now. That's good when you've got a strengthening economy, but when you've got a weakening economy and you start seeing borrowing numbers going up, that can signal potential problems. So it's been running fairly lowish of late. It's been up in the 40s, 50s, as you can see. So just keep an eye on that in case there's a big move outside of expectations, expected in at 16 billion. If it's very much to the hot side, 20s or something like that, might start to indicate something's going on. But we'll need to see a trend develop first. And with that all said and done, I hope you've all had a good week. Continue to have a good day today. Remember, Friday's pips are beer pips. Don't go spoiling any good work you've done in the rest of the week. If you have had a good week, switch it off, go and do something, go and spend it with the kids, or the wife, or the mistress, or the mister, however you want to do it. But have a good one anyway. Thank you for all your support. Thank you as always for Kay and all his valued input as well, and the guys around the back for keeping the show on the road. Have a great weekend, everybody. We'll see you all on Monday.
Cheers, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.